So essentially, the global outlook has been downgraded significantly in our April forecast. Just remember, we were forecasting, we had growth last year of 6.1%, and this year we're forecasting 3.2%, and next year below 3%. And you were asking about what are the big drivers. Well, if you look at geographically, the three main engines of global growth are really faltering, both the US and Europe, but also China. And there are three important factors, I would say, behind this downgrade in growth, or these gloomy sort of headlines that you were mentioning. So first, I think foremost is the ongoing war in Ukraine, and this is continued to impacting food, commodities, and overall sentiment. The second one is the weaker than expected growth in China. You've seen the impact that zero COVID is having on global chains. There's also ongoing issues on the real estate sector, but there was clearly a weaker than expected growth, and that has influenced actual growth and trade and global value chains. And the third, last one, but certainly not least, is what you were mentioning at the beginning, this persistently high inflation, which is resulting in very much in sort of a synchronized central bank monetary policy response, where all the central banks want to take control of inflation. The rising interest rates, as they've seen inflations that haven't seen at this level for decades. So just to give you a sense, in a matter of 3 months, since April to our July update, you've seen inflation prints that have surprised to the upside and led us to increase our forecast for inflation by 100 basis points just in a matter of 3 months.